Welcome to The Explainer. Today, we're going on a journey, and it starts with your wallet, but it ends on the global economic stage. We're going to connect the dots between that frustrating feeling you have about your own finances and the massive forces that are actually pulling the strings. So, if you've ever looked at your bank account and wondered why your money just doesn't seem to stretch as far as it used to, you're going to want to stick around for this.
I mean, seriously, have you ever felt this? You're doing everything you're supposed to. You save your money, you invest, you work hard, but somehow it still feels like you're just treading water, or maybe even slipping backwards. Well, I'm here to tell you that's not just a feeling. For a lot of people, it's a reality. And today, we are pulling back the curtain to figure out exactly why.
All right, so here's our game plan. We're going to start with two huge questions that every single investor is asking right now. Then we'll get practical and talk about how to survive a market downturn. From there, we're zooming way out to look at the big picture. This crazy inflation spiral, why our salaries can't seem to keep up, and the rules of the global economic game. And then we'll bring it all back home and figure out what this means for your strategy.
Okay, so our starting point comes from this letter written by an investor, and honestly, it just perfectly captures the two big fears that I think a lot of us are dealing with in today's economy.
And here they are. You've got these two different kinds of fear, right? On one side, there's the immediate, tactical fear, the what do I do right now fear. How do I get through a big market crash without going broke? But then there's this other, deeper, systemic fear, the one that keeps you up at night. Why does it feel like I'm on a treadmill I can't get off of no matter how fast I run? We're going to tackle both of these, starting with the tactical one.
So, let's set the scene. The market is tanking. Everything's in the red. Of course, panic starts to set in. You need cash to pay your bills, but the last thing you want to do is sell your investments when they're down in the dumps. So, what's the move? Let's walk through a clear playbook for this exact scenario. This is the million-dollar question, isn't it? If you sell your stocks when they're down, you're locking in those losses for good, and you're just draining your portfolio. But if you start burning through all your emergency cash, you're leaving yourself totally exposed. It feels like a lose-lose situation. So, what's the alternative?
Well, the strategy really boils down to how big your cash cushion is. Now, if you're sitting on a mountain of cash, and we're talking like 20-plus years of living expenses, you're in an amazing position. You can actually use a downturn as a buying opportunity, snapping up assets while they're on sale. But for most of us who probably have less than 15 years worth of cash saved up, the playbook is totally different. For us, cash is our lifeline, so the golden rule is you do not spend it. Instead, you get clever with the investments you already have. You rebalance.
So how does this whole rebalancing thing actually work in practice? Well, let's say you need to pull out about 2% from your portfolio just for living expenses for the year. In a down market, you really don't want to sell your main stocks. So instead, you can strategically shift some money around inside your portfolio. For example, you might move a slice of your portfolio from a standard index fund over to a related but more aggressive leveraged fund. A move like this can generate the cash you need, but it keeps you from having to sell your core holdings at a huge loss or dipping into that precious emergency fund. It's a bit of an advanced move, for sure, but the principle is what's important. Be strategic. Don't just panic and sell. Okay, so we've got our tactical plan for a crash, but that still doesn't answer that second nagging question, does it? Why does it feel like we're constantly fighting this uphill battle? Well, the answer starts with something that affects every single one of us, the inflation spiral. You know, an inflation spiral is basically a feedback loop from hell. It's this self-perpetuating cycle where everything just keeps getting more and more expensive, and it feeds on itself. Let's break down exactly how it works.
It all starts here. The price of everything. Gas, groceries, rent, it all goes up. So naturally, you and I need more money just to stay afloat, right? So we go to our bosses and we ask for a raise. Okay, now let's flip the script and look at it from the company's point of view. When they have to pay all their employees more, what happens? Their cost of doing business goes up. I mean, for most companies, labor is a huge expense.
And to protect their own profits, what do you think those companies do? You guessed it, they raise the prices on whatever it is they sell. And boom, just like that, we are right back where we started, with even higher prices. The spiral just keeps on spinning.
So what kicks this whole spiral off in the first place? Well, according to the source material we're looking at, a huge driver is government spending. When a government, especially a global powerhouse like the United States, spends way more money than it takes in, it often just prints more money to fill the gap. Think of it like pouring more and more water into a glass of juice. It just dilutes the whole thing. Every dollar that was already out there becomes a little less valuable. And this flood of new money doesn't just push up prices at home, it spills out across the globe. This is what's known as exporting inflation, and it's a huge reason why your money just doesn't buy what it used to.
Now, the logical question here is, okay, fine, inflation is happening, but shouldn't my salary just go up to match it? And the frustrating answer is, not necessarily. And the reason why has to do with where your country fits into the global economic pecking order.
The source we're looking at uses this really powerful analogy. It says to think of the global economy like a landlord and a tenant farmer. Some countries are the landlords. They own the valuable stuff, the brands, the patents, the big ideas. And other countries are the tenant farmers, the ones who do the actual labor. And, well, a tenant farmer's pay is always going to be set by the landlord, isn't it?
This example with Apple and its main chip supplier, TSMC, makes it perfectly clear. Apple is the landlord. They own the brand, the design, the software, the relationship with you, the customer, and that gives them all the power. They get to set the price and rake in massive profits. TSMC, on the other hand, is the tenant farmer. They do this incredibly difficult, high-tech work of actually making the chips, but they're a price taker. Their profit margins get squeezed because at the end of the day, if they charge too much, the landlord, Apple, can always threaten to find another tenant.
And this landlord-tenant dynamic, it doesn't just happen between companies. It scales up to the level of entire countries, creating these two very different economic models. You have developed nations, like the US, that often act as the landlords. They focus on the high-profit stuff, like innovation and branding. That generates huge profits, which can then support higher salaries. And then you have many emerging nations that play the role of the tenant farmer, focusing on the lower-margin manufacturing work. Their profits are always under pressure, and that in turn keeps a lid on how much their workers can earn.
Okay, so let's bring all this back home. We started with a very personal investment question, and we've zoomed all the way out to the structure of the entire global economy. So what's the connection? How do these two things actually link up?
And this right here, this is the big so what. That rebalancing strategy we talked about at the beginning, it's not just some clever trick to use in a bear market. It's a survival tool. It is your personal defense mechanism for navigating a global system where the value of your money can be diluted by faraway governments and your wages are constrained by forces way, way outside of your control.
So, let's wrap this up. What are the key things to take away from all this? First, powerful countries can and do use their currency to export their inflation problems to the rest of the world. Second, your country's spot in that global food chain, whether it's a landlord or a tenant farmer, directly affects how much you can earn. Now, the source material uses a really strong term for this system. It calls it a form of capitalist aggression, where powerful nations use their economic might to stay on top. And look, just understanding that this is the game that's being played, that's the absolute first step to protecting yourself and building a truly resilient financial life.
And that really brings us to our final and I think most important question. This whole thing isn't just about saving a bit more or picking a few hot stocks. It's about fundamentally understanding the world you're operating in. So you have to ask yourself, is my financial plan built on wishful thinking? Or is it built for the reality of this world, a world shaped by these massive, powerful, and let's be honest, often unfair economic forces? That's the real question you need to answer.